Thank you very much for zooming in. I'm Gavin Rochussen, Chief Executive of POLR Capital, and I'm accompanied by my Financial Director, Samir Ayub. Just to start, a very tough macro backdrop that we've been operating in, certainly the 6 months to the end of September. You'll all know it's been a very tough environment. POLR Capital has actually operated relatively well compared to our peers. We are shielded from the direct exposure to the UK retail market to a large extent. So just in terms of the summary of where we are, Hannah, next slide. Macro, as I said, macro environment very difficult. We've got 13 autonomous teams running very differentiated investment processes. Of those 13, 4 had net inflows during the 6 months. The others were a net outflow. All 13 had gross inflows, though. So the key for us is to focus on those that are actually in net outflow and try and reduce those outflows. The rate of outflow from our largest team, the technology team, that rate of outflow has declined significantly over the period. I'm pleased to say we were awarded the European Asset Management Firm of the Year award. That's for the firm's 20 to 100 billion euro category. And we've had numerous nominations for others as well. So a very successful period for us in terms of awards. Just in terms of what the backdrop looked like, the next slide shows you the major indices that we measure ourselves against. So you can see the peak of the markets, November 21, and the big sell-off as inflation and interest rates started rising. And of course, the markets sold off immediately, particularly the growthier stocks out there. The next slide just indicates exactly what caused that. So you can see the Magnificent Seven. We all know about those. So the 7 large mega cap stocks really drove the S&P and the markets. Without those, the S&P would not have outperformed during the course of the year. So you can see very narrow leadership from those large Magnificent Seven stocks. Very difficult for fund managers to compete with those. And then the next slide, again, that's US inflation, US interest rates, and you can see the rate rise on the right of that chart, the steepest rate rises in the last 40 years. So significant rate rises. And of course, that's had an impact throughout all the economies. As you all know, inflation is now coming down, 4.6% in the UK, less than 4% in the US. So good progress in getting inflation down. We believe we've now seen the peak of the interest rate cycle, and the question now is when will the first rate drop come? It's going to be next year sometime. We just don't know when, possibly second half. Moving on then to our performance across our teams. Hannah, we'll move on to the next slide after that. This chart here really just shows all of our UCITS funds. So these are our Dublin-listed UCITS funds, which we measure against their peer group. So this chart shows you a number of things. It shows you the quartile ranking versus the peer group, the upper peer group. The dark blue is first quartile, the lighter blue is second quartile, and the orange or amber is third quartile. We don't have any fourth quartile funds at the moment. So you can see pretty good performance across the board. The length of the bar above the line shows you the annualized relative outperformance against benchmark. So you can see some really high performance. So biotechnology, for example, income opportunities, another one, Asian stars, very good performance since benchmark, since inception. The only fund in the third quartile is our UK value fund. And if we go to the next slide, I'll explain to you why that fund has struggled. That fund typically will invest in small mid-cap UK domestic companies, and it's been a very tough place for them to be. So you can see the discount of the FTSE 250 to the FTSE 100 is the widest it's ever been in history. So almost 30% underperformance of the small mid-caps versus the large caps. And that headwind really affects the team that runs our UK value fund. Again, that's just another way of showing our AUM over various time periods and the quartile ranking. So you can see over 1 year, 73% of our funds are in the top 2 quartiles. Slightly weaker performance against peers over 3 years, 48%. And that's because Technology Fund, which is our largest fund, had an outstanding year in 2020. and then gave all that performance back in 21 and 22. So that's coming to their 3-year numbers. But you can see over 5 years and since inception, 84% and 93% relative to their LIPA peer groups in the top 2 quartiles. So a pretty good performance. Against benchmark, I won't dwell too much on this. Again, that just shows you over various time periods since inception. Again, you can see AuM over almost 65% outperforming benchmark since inception. Year to date, over 40% outperforming benchmark. The 3 factors that really differentiate POLR are the autonomous teams, the fact that we manage capacity, because we believe managing too much money impacts performance negatively. So we try and enhance and maintain performance by managing the capacity of the funds. And the third key factor for POLR differentiators, it's a very, very direct compensation model for the fund managers. So there's perfect alignment between the fund managers performing and the result that our investors get from their funds. This chart really just shows you, as at the end of September, what the capacity of our various teams are. So again, 13 teams. They ranked from the largest capacity down to the smallest at the bottom. Dark blue is the current AuM, and the light blue is the remaining capacity. So you can see significant capacity in these funds. Total capacity for the group was 63 billion, remaining capacity 44 billion. And interestingly, the capacity in the 4 funds or teams that have existing inflows and have had inflows over the last 6 months is 17 billion pounds. So again, those are strategies we're seeing current net inflows on those. The technology team, their major capacity there is in the artificial intelligence fund. So we're seeing a lot of interest in that fund coming in. And of course, we've got a lot of capacity still in healthcare and smart energy, which is within the sustainable thematic team. In terms of AuM and flows, you can see that's the progression of our AuM since March 2019. It's an annual compound growth of 7.5% over that period. And you can see peaking in September 21 at 23.4 billion. And then, of course, we had the big sell-off and net outflows, and that's brought it back down again. But fairly stable since then, so hovering around the 19 billion mark at the moment. And you can see the massive increase in AuM and the big flows we saw during the COVID year. So during 2020 into 2021, and of course, that all turned when interest rates started rising to try and curb inflation. That just shows you, of the 13, which teams had inflows in the 6 months, which teams had outflows. So you can see the left-hand 4 are net inflow. Emerging market stars, European income, sustainable thematic, principally their smart energy fund, and Japan value. And then to the right-hand side, you can see the net outflows for the period. The largest being technology, but a big reduction in terms of net outflows relative to prior periods. That's just showing you gross inflow in dark blue, gross outflow in light blue below the line, and of course the amber bar is showing you net flow. So that's showing the same as the previous slide, but it's just showing you gross and net. So you can see across all of the funds we had gross inflows. So we've got investors interested in coming into these funds. At the moment, though, we've got more investors taking their weightings to equity down. They're not disinvesting completely. All they're doing is adjusting their weightings to the growthier strategies. That's October. We felt it fair just to tell shareholders we had a really, really difficult October. Net outflows of 390 million, driven principally by 2 long-standing clients coming out of 2 of our funds. So we had a big redemption from biotech, where a European institution halved their weighting to biotech from an asset allocation point of view. And we had a UK wealth manager halve their UK equity weighting in our UK value fund as well during October. So very, very tough. Notwithstanding that, AuM at the end of October, or 10th of November, was still a touch under 19 billion. I'm now going to hand over to Samir to run through the financial aspects of the group.
Thanks, Gavin. Hello, everyone. As usual, a very similar format to previous slides. First, we look at the overall P&L and how it has changed from this time last year. And really, as Gavin indicated, the really tough macro environment and the outflows have meant that average AUM compared to the first half last year was roughly 3% lower. And on the bar chart on the right, you can see the impact on that first of three components of our overall profitability, our core profits and net management fees coming down as a result of the average AUM. And that in turn drives core profitability, which is essentially our net management fees minus all costs related with running the business related to management fees, driving that core operating profit number. You can see costs relatively flat on the remainder of that bar chart, and I'll delve into those in a little bit more detail. But moving on to the other lines of profitability, we have performance fee profits as well. The vast majority of our funds and AUM do carry a performance fee. However, performance fees crystallize at the end of December. The underlying funds crystallize those performance fees at the end of December, and therefore we recognize performance fees in the second half of the year. So therefore, it's not unsurprising that there are no fees in the first half. As a reminder, we indicated when we put out our second quarter's AUM at the end of September that performance fee profits at that point, so performance fees minus shares due to investment teams, we're tracking at 1.3 odd million. That number is knocking around at that level with a month and a bit to go before that figure is crystallized, just to give you an indication. And really what we're saying to investors is really outsized performance fees, given the size of the tech team, will probably be only delivered when that team comes back into performance fee territory. So do not expect a performance fee contribution from technology either this year and quite possibly next year as they sort of recover the underperformance from 2022. The third and final line of profitability is other income. And remember that is P&L, both mark to market and realize on our seed portfolio net of all hedging. And for the first time in a while, interest on bank deposits. We've done more on interest on bank deposits, but some of that is swamped by the mark-to-market movements on the seed portfolio and the hedging. So combining those three lines of profitability, all in adjusted diluted total EPS for the first half was 17.2p. And the board have maintained the first interim dividend at 14p, which is an 81% payout on those adjusted earnings. And I will cover the dividend in a bit more as we go through the slide. So moving on to the next slide, we look at costs in a bit more detail. Total operating costs were slightly lower than the first half last year at 55 million versus 55.8. And as you can see, the biggest component of our overall costs are unsurprisingly staff compensation costs. And within that, the largest component is variable. We have a profit sharing, revenue sharing model, i.e. there is alignment, as Gavin alluded to earlier, between the success of the teams and the profitability that they generate and the reward that they get. And therefore, as profits have reduced, the variable core distributions or profitability due to the teams has decreased on the bar chart on the right. That is demonstrated by that light blue line sort of coming down. We've done a bit more on other operating costs. And if we move on to the next slide, I will explain where that sort of cost base has increased. So looking at the next slide, really on non-staff compensation costs, there are two main lines driving that increase. All of the other lines are running at the same run rate that we started the financial year at. And that, I think, points to the sort of careful long-term management of the cost base over the longer term that we try and deliver on, even in the sort of inflationary backdrop that we're not immune to and we are facing alongside everyone. But the two lines where we have done a bit more, one is occupancy costs, rent and rates, where we have extended the lease on our primary London offices out to 2028. They were due to expire in 25. And we've taken a little bit of additional space on in the same building. Again, the thinking was really there along the lines of giving ourselves more runway before we had to take any big decisions on office space, and going out to 2028 provides us that. And the extra space that we've taken on just allows the business room to grow, and gives us certainty over the medium term. The other area where we've spent a bit more on a targeted basis over the first half is really doubling down on client engagement and our distribution teams getting out there and getting in front of clients, both to defend assets wherever possible, but also to try and position the business in the best way possible for as and when investor sentiment ultimately does change. So we've done more on travel, we've done more on marketing and digital content. And again, there is some flex for us depending on how things go to try and pull some of that back over the latter half of the financial year. Exceptional items coming down compared to the prior year, and really amortization of the Dalton investment management agreements that we picked up as part of that acquisition in 2021 being the only thing that is going through exceptionals now, and on a year-by-year basis. Moving on, we look at the balance sheet now over the next couple of slides. The first view is cash and seed investments, 107 odd million combined on the balance sheet at the end of September. And again, as you're aware, we use our balance sheet to seed new product ideas, and both for existing teams and team extension ideas, i.e. product extension ideas by existing teams, but also when we launch new products by new teams coming on board. And over the first half, what has happened is we have taken the seed money out of Smart Energy as that fund went through 100 million sterling roughly just after the March year end. And we have recycled some of that into EM Star's ex-China ideas, both in mutual fund for the US market and usage form for UK and Europe. Again, a reminder that all of our seed portfolio is hedged for market and currency risk. So again, the message there being really that the strong balance sheet profile continues. The next slide looks at the balance sheet strength from a different perspective. And again, from a regulatory perspective, and regulatory capital requirements for the business remain unchanged at 26 odd million, and surplus capital over and above that regulatory requirement is roughly 56 odd million. So again, a healthy surplus above those regulatory requirements. Other messages on this particular slide on the left, really very simple message is that the way capital is allocated across the balance sheet hasn't changed significantly. And the framework or the way we think about using our capital and our balance sheet hasn't changed. That graphic on the bottom right, again, we will use our balance sheet and our surplus capital to seed new product ideas as and when those come about, because really that is the R&D side of the business, and a way of delivering good long-term value for shareholders. There is an EBT buyback program that runs in the background to the tune of roughly 10 odd million pounds each year to really mitigate the dilutive impact of share incentive schemes. And then continuing to maintain and use that balance sheet strength as much as possible during difficult times, and ultimately return of capital through ordinary dividends. And if we move on to that final slide on the deck, again, this is a reminder of the dividend policy as it stands. And the chart really is a reflection of what has come up to now and a reminder. And the message really is first interim dividend maintained at 14p. It is a covered dividend at a payout ratio of 81% of adjusted earnings over the first half. And as we sit here today and think about the second interim dividend, the message is very simply that we have very good confidence in the business, the pipeline, the opportunity, and the ability to grow the business. What we have less visibility on and less control over is obviously the macro around us. And there are some very big things happening in that macro. The message with the second interim dividend is very simply, we need to get to late June 24 when that decision is taken by the board. And that decision will be based on the needs of the business, the needs of the shareholders, because we recognize that a number of our shareholders are here for the dividend and the yield, and how that all interacts with the outlook at the time and the outlook for future earnings going forward from that point in June. And the culmination of all of that, the decision on that second interim dividend, will be taken around that point in time in June. With that, I will hand back to Gavin, and we will take some questions later on.
Just to follow up on strategy and outlook, a few slides, and then we'll take some questions. Three of our funds on our Morningstar rated by the Morningstar analysts. We're very pleased with that. So that's the Emerging Markets Fund, the Sustainable Thematic Fund, that's Smart Energy and European Income. And the bottom half of that chart really just shows you over the years the new fund launches, and those funds we've actually closed down. So we do annual housekeeping. So we do close down funds that either do not reach scale or underperform. And you can see in 2023, we've launched two new funds. That's the Emerging Market ex-China Fund in both UCITS and mutual fund. And we're about to launch a European small cap fund run by the Forager team. And we closed down the Melchior European Absolute Return Fund. Also very pleased to announce the fact that our AI fund, our artificial intelligence fund, has now been in existence for 6 years. It's got a very good 5-year track record, and it's getting a lot of interest from investors. And the view is that the developments in AI over the last year to 18 months has now again extended the technology growth cycle quite significantly. So we are very well placed with a lot of capacity within our AI fund to take flows from clients who wanted to actually benefit from what's going to happen in that sector. 2 slides forward, please, Hannah. The next one. The other pleasing bit of news is our Global Insurance Fund marked its 25th anniversary since launch. A very successful fund. It's about £2 billion in total. And rather staggeringly, it has compounded returns of 10% per annum over that period of time of 25 years. So extraordinary performance over the long period for that fund. Moving on, I think the other one just to talk about is biotech. Again, the biotech fund reached its 10-year anniversary, and you can see there the performance of biotech in the top dark blue line versus the S&P 500 over that period of time. So that's October 13 to September 23, and against the Nasdaq Biotech Return Index. So way outperforming all of those. So very successful strategy for POLR. Samir alluded to the fact that we've doubled down on marketing, digital content, and actually reaching out to more clients in different regions. Now is the time to do that. So when the markets do turn, we're well placed to actually take flows. Our US funds have now exceeded £125 million since launch. We've had continued growth in the Nordic region with a local office established in Stockholm to service those clients. And of course, we have an office in Singapore to service our growing Asian client base. So you can see a really developing global footprint for distribution. Again, the next slide will show you just what we are doing on the marketing side. So you can see a lot of third-party events and conferences taking place. 14 in the UK this year, 8 in Europe, 4 in the US, 1 in Asia, with over 1,400 professional attendees at those conferences. And of course, from a pure marketing point of view, we are 7th in terms of top ranked brand in the UK, 6th in terms of marketing and communications, 6th in terms of best online events, and 4th in terms of best website across our peer group in the UK. So you can see a lot of effort and time is gone into that, and that's been one of the key factors that's been able to us to retain our AUM at the levels that it's currently been at. Again, next slide shows you third-party recognition. I'm not going to dwell too much on this, but some pretty key awards across there. I won't go to each one of them, but there's good third-party recognition for POLR here. That is quite a busy slide, so I'm not going to go through the whole thing. What it just shows you is our top 5 teams and strategies, and what percentage of our total AUM they make up. And that runs through from 2020 through to 2023, as at the end of September. So you can see tech was 55.9% of our total AUM in 2020. It's now 39.1%. And the reason for that is the others have grown. So the others have grown quite nicely. Tech has had some outflows as well. So it's getting that balance in place. So you can see the top 5 are growing. So tech, healthcare, global insurance, emerging markets, and UK value being the largest 5 of our 13 at the moment. And then finally, just a few words on outlook. Just to re-emphasize, we are a highly active specialist thematic investment house. So that's what we do. So we are differentiated. Our clients, our wealth managers, intermediaries use our funds as satellite offerings in their client portfolios. Strong brand recognition in the UK, strong peer group performance of our funds. And of course, I spoke about the 17 billion of capacity in funds that are currently in inflow. That is quite important. Samir touched on the strong balance sheet. That enables us to maintain the interim dividend. And of course, it provides funding for new seeding ideas going forward. And of course, the advances in AI has been staggering, and that's extended the technology growth cycle for some time period. On that note, thank you very, very much for listening to both of us, and very, very happy to answer any questions.
Could you comment on the pipeline and market conditions for acquisitions and team lift-outs?
Okay, so let's talk about team lift-outs first, because they are very different. Yes, there's opportunity there. We are currently in the process of onboarding a new team. We have not announced it yet because the individual is in the US and has a long non-compete. So we're busy preparing the way there. So that effectively is a new strategy geared towards the US market, is what that is. Acquisitions, slightly more guarded. It's never been POLR's policy to grow inorganically through acquisitions. Yes, we did acquire Dalton 2 years ago. That was effectively a small bolt-on acquisition, really to sort of get more investment skill in the European equity space, but also institutional clients in Europe. So that's the reason we did that. We're not actively seeking to go and acquire or consolidate amongst our peer group. That's not what we're doing, but we are alive to opportunities out there, because we're aware that valuations at the moment are fairly depressed in our sector.
Okay, thanks. If technology is leading the market, why are you not benefiting?
We are benefiting. So what's happened is a lot of clients have taken their technology weightings down in their portfolios. So they've come out of our funds. They haven't come out completely. What they've done is just reduce their weighting. But the fact of the matter is we are benefiting because the technology valuations have increased. I'll give an example. So calendar year to date, our technology fund is up 39.4% in absolute terms. So staggeringly, that has helped maintain our AUM despite outflows.
Okay, thank you. Can you expand on how you calculate available capacity for an investment team?
Okay, so we look at this every 6 months. It's always market adjusted, or what we call beta adjusted, because obviously liquidity in the market does change. But essentially, it's undertaken by our risk team, and it's a function of a number of things, mainly the portfolio concentration and the style of the investment portfolio. So if it's small mid cap focused with less liquidity, that will bring the total capacity of that fund down. If it's a very concentrated fund, that will also bring the capacity down. Obviously, fewer holdings in the portfolio. So that's very, very quantifiable in terms of what that is. We also have a sort of an overall limit in terms of what we think the teams can manage. A lot of our clients expect to have face time with our fund managers. So we also limit the number of clients that each fund has in them. So when we soft close a fund, we allow existing investors to increase, but we won't allow any new investors to come in. So that does limit the capacity as well. A lot of our clients, in fact, most of our clients would expect to see the fund managers on a regular basis, and they just cannot get around to multiple clients and investors. So we limit capacity for there as well. But the main capacity constraint is actually just portfolio liquidity.
Okay, thanks. There's a follow-up here to the technology. You obviously said you were benefiting in total AUM from strong performance, but this gentleman asks, why are you not benefiting from net inflows?
Not yet. So we've seen a rapid reduction in net outflows over the cycle, as we've seen with our peer group as well. And more recently, we've seen net inflows coming in. Too soon to tell whether that's going to be sustainable or not. But we have definitely seen a change in sentiment for tech and a lot of interest in our AR fund.
Okay, so the directional trend is the right one. They're delighted. This individual is delighted to hear you are relaunching the Euro Small Cap. What are your goals for such a fund, and what market cap limits?
Okay, so it's small cap. That's effectively run by the Forager team. It's the first client in there will be a US institutional client. So it's again geared for US investors who want to invest in European small cap, where they're seeing a lot of potential valuation uplift. So that's what that fund's being launched. It's actually a US institutional vehicle that we've set up for that particular fund.
Okay, thank you. There's a comment here on expenses for travel and entertainment. In terms of 1.4 million, are you happy with those levels? Do you think they're likely to go up or down? What's been the big impacts there?
I think there's a couple of things happening there. There's obviously our own targeted attempt to get out and in front of investors and clients over the 6 months. There is also incredible inflationary pressure through flights, etc. So again, this is all being done in a very careful manner, whereby it is part getting out physically in front of investors where that is possible and where there is appetite from the other side for that, but also increasingly what our distribution and marketing team are coming to realize. A lot of the decision making from our institutional buyers is now happening before we actually physically sit down with clients and investors, and therefore that the indication that we're doing more around digital content and more targeted marketing through that channel. And there's actually a multi-channel route there. That's where that spend is going. In terms of run rate, as I sort of indicated, we always try and manage the cost base in a sensible fashion for the long term. So again, depending on how the next half evolves of the financial year and longer term, there is clearly an imperative to continue investing in the business as we try and diversify geographically. There will be needs to do more in regions such as the US, more in Asia, and we approach those on a very targeted fashion on a cost versus benefit ratio. So 1.4 is probably a reasonable level to expect, and at the margins that might go plus or minus.
Okay, thank you. There was a lot of growth a few years ago in segregated mandates. Is this still a trend, or has it quietened down? And are there any specific fields where there is interest in this?
So it's fair to say it has slowed down. So there's a lot of interest across a number of our strategies out there. But I think the last 18 months, general demand for equities has waned, and likewise so has the demand for segregated mandates declined. There are numerous RFPs out there that we're currently responding to. And again, fairly low visibility in terms of length of pipeline. So the pipeline's there. We just don't know when it's going to convert to actual net inflows. So a lot of activity out there. No new mandates in the last 6 months, fair to say.
Yeah, lots of noise has been made about a big opportunity for asset managers in private markets and other alternatives such as infrastructure. Are you looking at any of these?
We have considered them. My view is that private markets, private equity is a very, very different business, different channel to market, different skill set, and we've decided not to pursue that. We've got enough opportunity within our specialisms at Polar Capital. On the infrastructure question, yes, we did look at an infrastructure team, so it was listed infrastructure. This goes back about 2 years, and decided not to pursue that. Again, we just felt we had better opportunities within our existing specialist portfolios.
Okay, well, thank you for everyone for attending. That's it for questions for now. And thank you both for your time presenting today. We look forward to hearing more in 6 months' time.
Thank you all. Thank you very much for listening. Bye now.
Thank you, everyone.